Welcome to the Plan Stronger Market Update for Wednesday, February 18th, 2026. I'm Anthony Hayes in for David today, as always, joined by Mr. Robert Mara. Robert, morning.
Good morning, Tony.
Hey, so we're going to jump right into the numbers right here and talk a little bit today about the path of interest rate cuts and realized inflation. And as we look at those numbers up on the board there, sliding our year to date right next to them, mostly green there, seeing a little bit of pullback there in the NASDAQ. Robert, looking at these numbers, I mean, we're starting to see a little bit of deterioration there in the last couple weeks. So what are some of the soft points? Are there any security classes that are showing a little bit more resilience, some safe places?
Yeah, so it's kind of a mixed bag for the numbers you've shown. Yeah. And so especially with the S&P 500, the total stock market index, and of course, especially the NASDAQ with those red numbers down 2.81% for year to date, and that, a lot of that has to do with the AI trade and a lot of investors saying, wow, the Magnificent Seven and all these huge companies, they really have to spend a lot of money on capital expenditures for the AI, building data centers and powering those data centers. So that's kind of the calculus we see there, especially with the NASDAQ. But international small caps and even bonds, you see those increasing from the last 2 weeks. So a lot of strength, especially in international, proving the case for diversification. Small caps holding their own. The Dow Jones more of a value-oriented index, also going up 0.7% since last time. So yes, we see some deterioration, but definitely some strong points in certain equity markets and bond markets as well.
Yeah, there's definitely certain areas that have that little bit of resilience, but last time the Fed didn't move interest rates at all. So as we continue to look at the rates, the market's looking at rates. Where are we going in the future with this?
Yeah, so let's have a good kind of a segue, talking about the markets and
Sure.
With interest rates. Let me put up a chart because I mentioned how well the bond market was doing just in terms of price appreciation. So the chart I really like to put up there is the percent off high. And putting up this chart at the very bottom, yes, we see almost a 5.6% deterioration in the NASDAQ. From off its high. And then, we have about 2.6%. Small caps are off their high. The other indices, a little more than 1% off. But look at bonds. In the last 3 years, they are at their all-time highs. Now, full disclosure, if you go back 5 years, 8 years, you'll see still 0.00% with bonds. You go back 10 years, it'll be negative 0.90%. So over the last 10 years, bonds are less than 1% off their high. Last 3 years, they are at their all-time high. So why do I focus on that? Because with fixed income securities, when prices go up, and we've seen that what Tony showed with the 2026 year-to-date numbers, bonds up 1.29%. 2 weeks ago, they were up only 0.03%. So in the last 2 weeks, they have gone up almost 1.3%. The reason is, as prices increase, yields, inflation expectations go down. So back to the Federal Reserve, Tony, with interest rate expectations, they're on pause. There's I believe a 92% chance that interest rates are going to stay the same between the 3.5% and the 3.75% that they're at now. Over a 90% chance that they're going to stay the same when the Fed meets exactly 1 month from today on March 18th. The time where that probability dips below 50%, meaning there's a greater chance of a rate cut, is on the June 17th meeting. So if anybody out there is thinking of refinancing, hey, when's the next rate cut? Probabilistically speaking, we have to wait till June for that next rate cut, because those inflation expectations, they're coming down, Tony, which is why we see fixed income prices increase, yields move in the other direction. So the Fed is saying, hey, inflation expectations are kind of coming down a little bit. We can kind of pause on a rate cut.
So they seem to have backed off this tariff explosion coming at any moment.
Oh, I wouldn't say that. A lot of people are still saying any day now we're going to see those, but that tarifflation, tariff-geddon storyline, of course, is still being heralded in certain sectors, but the data, it's harder and harder for them to fearmonger on that because the data just is not showing that.
The tariff bogeyman is not there. So as investors are looking at all this, the current environment, the yields could be pushing down, the rates are staying stable. What do we have to kind of put into consideration for these investors? What are the highlight points there?
Yeah, so first and foremost, I think we mentioned the diversification, especially with non-U.S. equities. We talk about non-U.S. developed markets, Europe, Japan. Also, emerging markets have done very well. Both of them completely different asset classes from U.S. Small caps and mid caps holding their own. And again, not to say completely get out of U.S. tech. That has not been a good option for the past 10 years. U.S. tech is not out, but the point is 2023, 24, 25, we've had a very strong rebound in the NASDAQ from when interest rates spiked up. So of course, keep your allocation to U.S. growth because one of the reasons I put that chart up, negative 5.59% from an all-time high. It's not down 10, 15, 20%. It's not down 50%. We're not in a bear market, but again, one of the main reasons we do this, with David and you, Tony, and I come on here is yes, there's a lot of data that people can glean from listening to the news, but it's really trying to divorce yourself from the emotion of it. Yesterday, the last few days, we've had some pretty rotten days with the stock markets and people looking at the market, seeing, oh my gosh, it's down 0.5%, it's down 1%, it's down 1.5%. Look at it, it's down not even 5.6% from its all-time high. So yes, we are seeing deterioration, but that's completely normal. But it might be a good time to divert, if you haven't already, like the non-U.S. international trade, emerging market trades, small caps. A lot of people believe that we're just kind of getting started on that, and it's not a time to, go, and it's never a time to go all into one asset class. So,
Robert Marr, great information. I'm going to take tariff-geddon to Webster's and see if we can't get that word put in there.
Yeah, exactly. And just one thing, Tony, you at the very beginning, we mentioned, inflation expectations and actual realized inflation. We'd be here another 10, 20 minutes if we're going to talk about that. So that's going to be up next for our next episode. I'm going to focus on talking about, exactly where are we in terms of the inflation metrics, what metrics there are, and what the slope of the downward curve that we're seeing. So, people can realize now, are prices still rising? Yes. Have we reached the Fed's inflation target of 2%? No, we're still a bit above that, but we're moving in the right direction. And so the next episode, I want to focus on, those numbers and those inflation metrics.
Getting through those metrics in spite of the noise around it. Sounds
exactly.
Great. Well, tune in next week for Robert's extended version on that. This should be great. And as always, we're here to help you plan stronger.